Welcome to US Market Pulse, your trusted source for clear, honest and independent analysis on gold, silver and global market structure. Today we are discussing a shift that most investors are still underestimating. A quiet but powerful change is unfolding inside the Shanghai silver market, and its consequences are not years away. They are forming right now and accelerating into 2026. This is not a headline shock. This is not panic. This is controlled pressure building beneath the surface. And historically, it is this kind of pressure that leads to violent repricing later. If you hold physical silver, trade futures, or want to understand where silver prices are really heading, stay with me until the end. Before we begin, tell me in the comments, have you noticed higher silver premiums or delivery delays where you live? Those signals usually appear in the physical market first. The core issue starts with China's new export control system on refined silver effective January 1, 2026. Let me be precise. This is not about global silver supply disappearing overnight. This is about tradable refined silver being quietly restricted at the exact moment the market is already tight. China refines more than half of the world's silver. Under the new system, exports are no longer broadly permitted. They now require case-by-case approval and are limited to large state-approved firms. This shifts priority toward domestic use and away from global availability. When marginal supply disappears, prices do not adjust slowly. They reprice. Industrial buyers cannot walk away from silver. Solar panels, electric vehicles, electronics, and data infrastructure depend on it. Silver is not optional. At the same time, investors holding physical metal begin to realize something critical. Replacement cost is rising. In this environment, silver does not need panic to move higher. Even controlled stress can push prices into the $80 to $100 range, with spikes beyond that if physical tightness worsens. This view is not speculative. Mainstream financial outlets are now openly discussing strategic metals. Technology leaders have warned that silver shortages directly affect EV and solar expansion. More importantly, the data confirms it. Shanghai inventories are falling. London vault levels are trending lower. Registered silver in New York continues to shrink while paper claims grow. This matters structurally. Silver is primarily a byproduct metal. You cannot rapidly increase silver mining without increasing copper, lead, or zinc production. Recycling helps, but it operates with long delays. Meanwhile, industrial demand is fixed and rising. When China keeps more silver inside its own system, the rest of the world is forced to compete for fewer available ounces. Some analysts argue markets had time to prepare. I disagree. Structural deficits since 2021 have already consumed the buffer. This is not hype. This is pressure building quietly. And historically, quiet pressure is what leads to sudden repricing. The real stress in silver does not show up first on price charts. It shows up in the physical market. One of the clearest signals is backwardation. That is when buyers are willing to pay more for silver today than for delivery in the future. This tells you one thing clearly. Silver now is more valuable than silver later. At the same time, lease rates have spiked. That means lenders demand higher compensation to part with physical metal. Shanghai premiums have widened sharply compared to COMEX pricing. Local buyers are paying extra to secure supply. When premiums rise faster than futures, paper markets are lagging reality. This creates a dangerous structure for a system built on leverage and paper contracts. If physical tightness persists, the question stops being price and becomes availability. Industrial users rush to secure supply. Investors remove metal from exchanges. Confidence in paper settlement weakens. Exchanges do not collapse, but they adapt. Contracts are rolled. Cash settlement increases. Physical prices detach and move faster. Historically, this is when silver moves violently. Gold follows as capital seeks stability. Lease rate spikes in 2025 reached levels only seen when physical silver becomes urgent to borrow. Corporations have responded by increasing long-term supply agreements and pre-buying contracts. Companies do not do this unless supply risk is real. China's export controls effectively restrict an estimated 15 to 25% of tradable refined silver. Not through bans, through slow approvals and limited participants. Global buyers are pushed toward alternative sources with higher political, logistical, and financial risk. The global silver market produces roughly 1 billion ounces per year. Annual deficits continue to drain inventories. Analysts interpret this differently. Some see a slow transition. Others expect sharp repricing. My independent view sits between emotion and mechanics. This setup resembles past squeeze conditions not because of speculation, but because supply is constrained while demand is non-negotiable. If this imbalance continues, the gold-silver ratio has room to compress sharply. Silver leads. Gold benefits as confidence insurance. Let me ask you this: are you holding physical metal, paper exposure, or miners? That choice matters more than ever in this phase. Silver demand from electrification, renewable energy, and artificial intelligence is not optional. And it is not price sensitive in the short term. This makes silver one of the most inelastic metals entering 2026. When supply cannot respond and demand does not slow, pressure accumulates. That leads to three possible paths. 1. In a mild friction scenario, prices grind higher. 2. In a stress scenario, volatility spikes and premiums expand. 3. In a full break scenario, governments and large buyers bypass open markets and allocate supply directly. Each step increases volatility and pulls gold higher alongside silver. Gold plays a different role. Silver brings acceleration. Gold absorbs fear. Central banks continue accumulating gold. Precious metal ratios historically compress when silver stress becomes visible. Silver tends to move first. Gold follows when instability spreads. Gold supply is more flexible. Silver's is not. When silver enters backwardation, investors question paper pricing across the entire metals complex. That alone lifts gold demand. China's policy direction adds another layer. Resource nationalism pushes institutions toward assets outside political supply chains. Opinions differ. Some expect explosive moves. Others expect a slower process. My disciplined conclusion is this: silver is likely to lead in percentage terms. Gold remains the foundation. Overexposure increases risk. Ignoring silver misses opportunity. Watching physical premiums, lease rates, and the gold-silver ratio matters more than daily price noise. So before we wrap up, tell me in the comments, are you preparing for friction, stress, or a full break? The bottom line: the Shanghai silver market is sending early warning signals. Export controls, shrinking inventories, rising premiums, and inelastic demand are connected. Silver does not need panic to reprice higher. It only needs continued tightness. If conditions escalate, volatility will follow. Gold will benefit as safety capital moves in. Silver will become the focal point of scarcity-driven repricing. This is not hype. It is structural. Prepared investors focus on systems, not noise. If you found value in this breakdown, support US Market Pulse by liking the video, subscribing for independent gold and silver analysis, and sharing your view below. Understanding the system is the real edge. Stay disciplined, stay informed, and I'll see you in the next update.